Another short-term decision that management sometimes has to make is to determine which products they're going to produce and sell. Like everything in life, companies have limited resources. They can only manufacture so much. Yet people are only willing to buy so much of a certain product. So most companies have a mix of products that they have. They have different offerings, different product lines, different segments of their business, etc. And some of those products that are being made may not be as profitable as others. Nike is a grand example of this. Nike very hardly got into the golf game in the early 2000s when Tiger Woods was blowing up. They made clubs, they made all sorts of golf equipment, and they soon found out that the margins they were receiving on their golf products were nowhere near what they were getting off of apparel, namely basketball sneakers. So they decided that they needed to free up capacity. They were producing all of the goods that they possibly could. They were wasting their time making golf equipment when they could just make more shoes and have a higher overall margin. So they made the decision to change their product mix, as they call it, to get rid of golf entirely, to discontinue that segment, and to move their limited capacity over to other products. So there's a bunch of different things that companies could have. They could change their product mix. Maybe they are a store that has multiple different areas. They have departments they could get rid of. They could operate in different territories and realize that the money that they're sending and spending on goods in certain, or labor costs in certain territories, would be better spent elsewhere. Which is why when you travel around the U.S., you see fast food chains in different areas that do not appear up here in upstate New York, if that's where you're from. They simply just never caught traction. We don't have a Jack in the Box up here. You can't go more than 5 feet in the Carolinas and Georgia without finding one of them. They decided not to even try to enter that territory because it wasn't profitable for them. So they dropped any plans for expansion and instead spent those funds on expanding the foothold of the area that they already had. So what factors do we have to take into consideration when we're considering dropping a product or a certain segment of our business? And the first one is, does it have a positive contribution margin? Are the revenues that you are receiving in excess of the variable cost that you have to pay to produce that product or operate that segment? And if they're not, if you're spending more in costs than you are generating in revenues, let me recant on that, you're spending more in variable costs, which you could avoid, than you're generating in revenues, it makes zero sense to continue to produce. So if you have a negative contribution margin on a product or a segment of your business, it's a hands down pretty easy decision that you're better off doing anything else with the resources that you have, your production capacity, and your available cash flow. If you have a positive contribution margin from a product, but it's not contributing to operating income, something's got to be going on with fixed costs. So if you have a positive contribution margin, your next step is to analyze your fixed costs. And you really have to ask yourself, if we drop this product, if we stop producing this product, if we discontinue this segment, are the fixed costs related with that product or segment, respectively, going to continue to exist? Are we paying rent on a factory that we have a lease for that we're stuck paying, even if we discontinue a product and don't use that facility at all? Is there a manager, a production manager, some administrator that works there, and he or she has a contract and is on salary, and if we discontinue the segment that person oversees, we're still stuck paying their salary, that would continue to exist? Is that something that can happen? Or are some of those fixed costs avoidable? Does our lease run out on our rent and we can get out of it in full? Is the terms of that person's contract expired and we can just let them go if we discontinue the segment? That would be an example of avoidable direct fixed costs. Beyond that, there are other things that we need to consider. One is, do we have any products that are complementary, as they say, to the product that we're thinking about getting rid of? Like imagine Heinz getting rid of mustard but continuing to make ketchup. A good example of this that I can think of off the top of my head is I am a big Instacart shopper. And my go-to, because I'm cheap, is typically Aldi. However, there are some products that Aldi doesn't have that I would, need that I could get from elsewhere. But I'm never going to go through and decide that I'm going to buy X amount of stuff from Aldi, X amount of stuff from Market 32, X amount of stuff from Walmart, X amount of stuff from Price Chopper or Tops or wherever you want to go from, and make like 5 different orders. If Aldi decided they weren't going to sell produce anymore, or if Walmart decided that they didn't want to sell cereal or beverages or something, they're going to lose the sales that they would make on other, products that I typically buy from that company, because I don't want to have to sit there and spend a whole entire day making Instacart orders. So sometimes dropping a product can actually hurt the sales of your other products. And the last bullet point on this slide is a big one. Do we have a plan for our freed up manufacturing capacity, shelf space, whatever our constraint, our limitation is? Do we have a plan on what we're going to do with it, or is it just going to sit there idle and empty? Because that is very relevant information to your decision. That is revenue that you could generate that would not exist if you take the other alternative. So here we have Smart Touch Learning. Let's say now that Smart Touch has 2 different lines of tablets, the standard and the premium. Going right to the bottom line over here, if I can get my cursor in place, we see that the premium tablets, when broken down, are leading to an operating loss, losing money as it stands right now on the premium tablets. Should we get rid of them? Well, that's a tough question. First thing you got to ask yourself is, does it have a positive contribution margin? And as we see here, it does. The sales that come from the premium tablets are $230,000. They cost $140,000 in unique variable costs to make. Therefore, their sales exceed their variable costs by $90,000, and that is money with which we can contribute towards paying our fixed costs. So we can't just straight up rule out the premium tablets right now, because they do have a positive contribution margin. Now what we got to figure out is what happens with these fixed costs. If we have to continue to pay these manufacturing fixed costs and these selling and administrative fixed costs, in total $95,000, well, it doesn't make sense to get rid of the premium tablets. Yes, their margin is less than their fixed costs, but if we got rid of them, we'd lose that entire margin. If we're stuck with that $95,000 of fixed costs, we're actually worse off. However, if they're avoidable, if we can get out of this entire $95,000 right here, well, then all of a sudden it makes sense to get rid of the premium tablets, because we can get out of a total of, if we add these together, $235,000 worth of costs that are only causing us to generate $230,000 worth of revenue. In essence, we are going to increase our operating income by $5,000 in total if we get rid of that premium tablet. So again, first question, is contribution margin positive? If the answer is no, that product or segment is gone. Sorry, if the answer is no, it's not positive, it's gone. If it is positive, the second question you got to ask yourself is, what happens to our fixed costs? And that is something you're going to have to delve deeper to look into. So skipping the slide right here, let's say right now we can't get out of any of our fixed costs. Well, the only cost savings we would have was that $140,000 of variable costs that came with the premium tablets, which means we would be saving $140,000 in cost, but we'd be giving up $230,000 in revenue to do so. Overall, the effect this is going to have on our company-wide operating income is a decrease of $90,000. Doesn't sound very strategic to me. If, however, we can avoid the majority of these fixed costs, backing up a few slides here, we see that our total fixed costs were $95,000. Let's pretend that we can get out of $92,000 worth of those fixed costs. Well, now, discontinuing the premium tablet not only allows us to avoid paying the $140,000 in variable costs, it allows us to avoid paying $92,000 in fixed costs. So we got out of paying fixed salaries or whatever fixed costs we got to avoid in here. In total, we're going to save $232,000 worth of costs we would have had to pay to continue to produce that premium tablet. And since continuing to produce the premium tablet is only going to bring us in $230,000 of revenue, discontinuing that particular product line saves us more in costs than the revenue we are foregoing. And in total, it is going to increase our overall operating income by $2,000. Again, numbers only count for so much in management. You want to have the numbers as the basis of the decisions that you make, but they shouldn't be the sole reason for your decision. If we think right now that discontinuing the premium tablet is somehow going to affect the sales of our standard tablet, well, then that number change of $2,000 might not be true overall, because we didn't account for any change in the standard tablet when we were going through as well. Secondly, what about freed up manufacturing capacity? Going back here, we said if we discontinued this product and we had to be stuck paying all the fixed costs, we'd decrease operating income by $90,000. That's true. But that's true only if we leave that capacity idle. What if we have another plan that's going to, to make a new product that's going to bring in $150,000 worth of income? Well, then obviously the better idea is to discontinue the premium tablet, even though it has a positive contribution margin, because we can use that freed up capacity now to do something else, to make a new product which we expect to be infinitely more profitable. So doing the differential analysis to discontinue a product requires you to think not only about what other factors besides the bottom line of that particular item, are going to change, but also what other plans do you have? What other decision alternatives can you make? So in review right here, overall, just on the money end of things, when you're deciding to drop a product or a segment, the question you need to ask yourself is, how do our revenues compare to our cost savings? And if your lost revenues are greater than your cost savings, if you're giving up more revenue than you're saving by getting rid of those costs, you obviously will not drop it. If you're going to be able to get out of more costs than your lost revenues, or if your lost revenues are less than your total cost savings, well, then you should drop the product.